In this video, I want to talk about excessive optimism, the catalyst behind stock market bubbles. That is how excessive optimism uh, brings about stock market bubbles. So I want to look at this particular topic under 9 perspectives. Number one is overestimation of future growth. Overestimation of future growth. So excessive optimism, occurs when investors have an overly positive outlook, on the future of the market or the assets they've invested in, the performance of the asset they've invested in, and this is often based on short-term trend rather than long-term fundamental analysis. This belief, leads to overvaluation as sectors expect rapid growth that may not be sustainable. That level of growth generally is not sustainable. So they assume that higher returns would continue indefinitely, disregarding potential risk or underlying economic conditions. Nothing lasts forever, Essentially, the price will there will be correction to the mean. There will be reversal to the mean, in the future. Number two is hard mentality and speculation. Hard mentality and speculation. Optimism in the markets, can trigger, a kind of hard behavior where investors follow others into a trending stocks or assets class, hoping to profit from the momentum or the rally. So as more people buy into the assets, the price keeps on, increasing. It tends to inflate the price, regardless of whether the intrinsic value of the asset justifies the price or not. They don't really care. They just keep on buying, buying like that. And so speculative buying actually is driven by the belief that the price will keep on rising. That's the essential belief. The price will keep on rising, further amplifying the bubble. But how can somebody believe that price will keep on rising, just keep on rising? And it doesn't happen like that. It must surely fall. People will come back to their, to their logical senses and discover that the market is overvalued, and then they will sell. They will take profits, and then the price will plummet. Number three is ignoring fundamentals. When optimism is excessive in a market where there's euphoria, investors may overlook key fundamental metrics. They will overlook the PE ratios. They will neglect, the price to book ratio. They will even ignore yield, or the debt level of the company, and they instead focus on market sentiment and price momentum. They focus on what doesn't really matter on the long run. This detachment from fundamentals leads to inflated stock prices, as a belief, in the continued growth, overrides rational analysis or an assets or a stock true value. Number four is the media hype and public enthusiasm. So excessive optimism is often fueled by media. We're living in a time of information overload. So the news items, the news feeds keeps coming in, and then people react accordingly. And so it leads to a kind of widespread, optimism, enthusiasm in the market. When stock prices rise and positive news or stories dominate the media, more investors, including those with little experience, that's the problem. are drawn into the market. They will just use their apps and then, deposit funds and key in a buy order and hope, believe and pray that the stock will keep on climbing. Okay. This can lead to a surge in buying activities, further driving up prices and inflating the bubble. Number five is fear of missing out. Fear of missing out, FOMO. Because excessive optimism encourages the fear of missing out among investors, leading them to buy stocks at inflated price for fear of not being part of the rally. You don't want to miss out. You want to benefit from the gains in the markets. This emotional response amplifies demand, and as demand increases, the price will increase alongside. The price will increase. So this will push the market towards a bubble territory. And so FOMO can make investors believe that missing out on the rise is riskier than joining in, even when the market shows signs of overheating. Please subscribe to this channel and like this video. It will do me a ton of good. Number 6 is overconfidence and leverage. As optimism grows, you discover that investors become overconfident in their ability to pick winning stocks, or they may end up timing the markets. This overconfidence may lead to increased use of leverage. Go and borrow money, go into margin, open margin accounts. Where investors borrow money, they borrow money to amplify their gains, forgetting that they can equally amplify their losses. While this can drive prices up to, it can drive prices up on the short term, it also increases the potential of significant losses when the bubble bursts, because essentially leverage would amplify one's losses. Number 7 is a mispricing of risk. Mispricing of risk. So excessive optimism can lead to mispricing of risk as investors become overly focused on potential rewards and downplay or ignore the potential of a downside. They ignore downside potentials. As a result, assets are highly speculative or risky, and assets that are kind of risky or speculative, become overbought. People buy them in excess, creating an environment where even high-risk investment appears to be safe or highly profitable. People tend to lose their sense of logic. Okay. Number 8 is disconnect from from economic reality. Disconnect from economic reality. So when optimism is excessive, market participants may disregard broader economic signals such as inflation, interest rates, or geopolitical risk that could affect market stability. So the assumption that the markets will keep growing can cloud judgment, preventing investors from considering whether asset prices are supported by real economic conditions or not. That's the reality of of this kind of market condition. Number 9 is rising expectation of quick profit. Rising expectation of quick profit, quick gains. So optimistic expectations, about making quick profit can drive price up in the short term. Where investors hope to sell before the bubble bursts, ignoring the fact that nobody knows precisely when the bubble will burst, and people that are influenced by greed may not be able to sell on time. They say, let me wait, it might increase. Prices may increase. If you understand, the price will plummet without them being able to sell on time. And so this buy now, sell later mentality, encourages price inflation that, but leaves little consideration for long-term value or sustainability. People tend to be kind of short-term oriented. They ignore long-term, perspective when it comes to investing. So in conclusion, excessive optimism plays a key role in creating stock market bubbles by kind of, by driving speculative behavior, inflating asset prices and fostering a disconnect from economic fundamentals. As the belief in endless growth overtakes rational risk assessment, markets become more susceptible to sudden correction when the reality of unsustainable prices set in. The reality will always set in that this price is not sustainable. Then the market will self-correct. Investors may end up losing their money as a result.